Trading often feels like a complicated puzzle, with countless indicators, overwhelming charts, and conflicting advice. But here's a refreshing truth. Trading doesn't have to be difficult to be effective. In fact, some of the most successful traders keep things surprisingly simple. Today, we're going to dive into a trading strategy that even a complete beginner can master. It's called the moving average crossover, and it's designed to help you cut through the noise and trade with clarity. By the end of this video, you'll understand exactly how to use it to make better trading decisions. Before we get into the strategy itself, let's talk about why simplicity in trading matters. It's easy to get lost in the labyrinth of complex tools, mathematical formulas, and fancy-sounding techniques. But the reality is, trading is less about finding the most complicated system and more about sticking to a strategy that works consistently. Simplicity eliminates overthinking, reduces emotional decision-making, and allows you to focus on what's truly important, managing your risk and following a clear plan. So let's strip away the complexity and focus on a strategy that is straightforward, effective, and easy to follow. The moving average crossover strategy revolves around just two lines on your chart, a short-term moving average and a long-term moving average. For those who are unfamiliar, a moving average is a tool that calculates the average price of a stock or asset over a specific time frame. Think of it as a way to smooth out price fluctuations and reveal the underlying trend. The short-term moving average reacts quickly to recent price movements, while the long-term moving average moves more slowly and reflects broader trends. These two lines work together to give you clear buy and sell signals, and setting them up is incredibly easy. To implement this strategy, you'll first need access to a trading platform. Popular platforms like TradingView or MetaTrader are great places to start, and many of their features are free. Once you've opened your platform and chosen an asset to trade, whether it's a stock, cryptocurrency, or Forex pair, you'll need to add two moving averages to your chart. Set the first one to a 50-period moving average, which will act as your short-term trend line. Then add a 200-period moving average, which will represent the long-term trend. Once these lines are on your chart, you're ready to start spotting opportunities. The key to this strategy lies in understanding what happens when these two lines cross. When the 50-period moving average crosses above the 200-period moving average, this is known as a golden cross. It signals that momentum is shifting upward, making it a great time to buy. On the other hand, when the 50-period moving average crosses below the 200-period moving average, this is called a death cross. It indicates downward momentum, signaling a time to sell. These crossover points are your trading signals, and the beauty of this strategy is how visually intuitive it is. Let's take a real-life example to make things clearer. Imagine you're analyzing Tesla's stock. For weeks, the 50-period moving average is below the 200-period moving average, reflecting a downtrend. But then one day, the short-term moving average rises and crosses above the long-term moving average. This crossover is your golden cross, the perfect signal to buy. Over the following weeks, Tesla's stock price climbs steadily. Then the opposite happens. The 50-period moving average crosses back below the 200-period line, forming a death cross. This is your cue to sell and lock in your profits. Now, while the moving average crossover strategy is simple and effective, no strategy is foolproof. Markets can be unpredictable, and that's why risk management is crucial. First, always set a stop loss to protect your capital. A stop loss is a preset point at which you'll exit a trade if it moves against you, preventing significant losses. For example, if you bought Tesla after a golden cross, you might place your stop loss slightly below a recent support level. This way, even if the trade doesn't work out, your downside is limited. Another key aspect of risk management is position sizing. Never put all your money into one trade, no matter how confident you feel. A good rule of thumb is to risk only 1 to 2% of your trading account on a single trade. This means that even if the trade goes wrong, it won't wipe out your account. Lastly, discipline is your best friend when trading. Stick to the rules of the strategy, trust the signals, and avoid making impulsive decisions based on emotions. While this strategy is incredibly beginner-friendly, there are a few common mistakes to watch out for. One of the biggest is overtrading, entering every single crossover you see, even in weak or choppy markets. To avoid this, focus on strong trends and higher time frames, like daily or weekly charts, for more reliable signals. Another mistake is ignoring the broader market context. Always check the bigger picture to ensure the signals align with the overall trend. And remember, trading is not about being right all the time. It's about managing your losses and letting your winners run. If you want to take this strategy to the next level, you can combine it with other tools like support and resistance levels or volume indicators. For instance, if a golden cross occurs near a major support level with high trading volume, the signal becomes even stronger. These additional layers of analysis can help you refine your entries and exits, making the strategy even more effective.